Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, the smart money is leaving the market and we're going to show you the data that proves it. So let's dive into this video.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
All right, guys, we're going to dive into some data here just to give you guys an update on what's going on under the hood in the markets, as well as why we think inflation isn't going anywhere. So, Bob, lead the way.
Yeah, I think the first chart we should show you here, this has almost a 100% predictive value here. It's when the smart money drops, the index drops, you get a corresponding 1 month lag and the market drops with it. And so we just had a big move, 7% drop in the index. The market's starting to cooperate with that, but it looks like August is going to be a very red month, Phil. But that's just the start of the problem. Check out this next chart. Okay. Corporate bond yields versus the Fed fund rate, another alligator. When this thing snaps, okay, that means corporate bond yields are going to be rising here. This affects companies' profitability, Phil.
This is a great leading indicator too. If you look at it, similar situation to the 2000s, right? 2001 dot-com bust, great financial crisis. This was an awesome leading indicator, and same ahead of COVID too. Always the bond market, right? Always sniffing things out ahead of time. It's just a matter of timing, but they're telling you that it's coming.
Yeah, I mean, look, this is complacency 101 that's just going to get absolutely obliterated with what Powell's doing.
Yep.
But there's even more information. This is crazy. This is household net worth, Phil. Yeah. Remember this weekend we talked about gross domestic income?
Yes.
Look at this absolute destruction in net worth. And you know what? This isn't even done yet because they haven't marked to market all the commercial real estate that is blowing up. Remember, only rich people are in these commercial real estate funds, okay? Might be some retail in them, but a lot of times you have to be a accredited investor to even be allowed to get in some of this stuff. And it's just going to wipe out household net worth on the upper end, which is really going to drive the price down because obviously poor people don't have much net worth to lose, right? So this is going to contract even more. And every time we get a contraction like that, we go into recession. So This one I think is going to beat the 2008 drop in my view, because this rise was the magnitude of the rise. The fact that it's falling so hard after people got so much money should freaking scare you out.
Yeah, and it's scary too because we haven't even entered recession. Or last couple of times we've gotten down to these levels, we've already triggered the GDP contraction. Yeah, like you said, because we've gone from such high valuations in these readings, and it's like that on a lot of things, right? But we're seeing that certain things are leading lower, much like how some stocks have already fully round tripped the COVID lows, while others are making highs, and so there's a lot of dislocation going on, which is to be expected when you have put $2 trillion in the economy faster than ever before, and getting it out of the system creates a lot of collateral effects and strange dislocations. And I think that's what we're seeing right now, why things sometimes just don't make a lot of sense right now.
Yeah, absolutely. And I think the lag effect is amazing. But yeah, this one here too, I'll let you speak to it because when I saw this one, I just started laughing out loud because I'm thinking of companies like Nvidia and Netflix and these companies that are just bizarrely overvalued.
Yeah. So the PEG ratio, it's kind of a lengthy definition, but essentially what that means is they're looking at the PE ratio versus the estimated forward growth. And as you guys can see, basically what it is, it's a measure of how overvalued something is. And right now it's at just extreme levels that you haven't seen except for when we're in a bubble that's about to collapse. And you can see that par for the course, especially in the .com bust, which I believe is a great comparison here because AI is just another internet .com boom thing, right? Where just extreme valuations on tech that yes, it's going to be around for a while and it is revolutionary in terms of, productivity and things like that, I think, going forward. But the maturation takes time, and these valuations are pricing in things that are, 5-10 years down the line. So when you look at the dot-com bust, a lot of things they were pricing in did come to fruition, but it took 5 to 10 years for that to really happen. It wasn't like, instantly things were going to change and forever these valuations were going to stay here. It's just another bubble, and it's just another leading indicator that we're probably in for a collapse in valuations as things roll over. What the catalyst is, I think it's going to be unemployment, Bob. When it cracks 4.5%, I think that's when you're going to start seeing things crack lower. And also the yield curve inversions are starting to put a bottom in and normalize. And I really think that's something else we can talk about maybe in tomorrow's video, when these various yield curve inversions, because it's not just the typical 210, there's other, the 3-month and things like that. When those start to crank back up and get to not only par, but then start normalizing back to their more positive values, I think that's when you're going to be able to say, yeah, we got confirmation that the recession is here.
Yeah, and you got to remember, although let's talk about that tomorrow, because there is a ratio when that steepens.
Right.
But you know what? This is the one that I enjoy the most, because I'm really heavy energy long, and I saw this rig count thing. I'm like, yeah. Did you see? But I got a little nervous because we hit resistance on oil 80. It just ripped through it like butter. And not just that, you see coal today, uranium today, lithium, right before we started doing this podcast, just all of a sudden went boom. And I think what's happening here is that there's a recognition now that the Fed's not going to be able to control the commodities. You saw this weekend, Niger just had a coup, took out the corrupt government that France was propping up, promptly cut off France from exports of the metals. And I think what we're going to see around the whole world is countries and we talked about this before, they're going to defend their domestic production, because they're not going to let the multinationals just take it and profit from it somewhere else. And that's why I've always been telling people I like buying things that are in the US or Canada, maybe even Australia, but Australia's getting weird too. That way, it's at least closer to home where these things aren't as likely, because it's going to be domestically produced. So just keep an eye on that. This is absolutely amazing. ExxonMobil also, there's rumors that they're getting into the lithium business. So that might be the reason why these lithium stocks ripped. ExxonMobil is sitting on hundreds and billions of dollars in cash. Billions. They're looking for an acquisition. And they were messing around with PDS, went from 57 up to 68 or 69, I think it's right now. That was a rumor. And then all of a sudden this news came out that they're in talks with these automakers about providing lithium. Well, you don't provide lithium unless you are extracting lithium. So they may have a target in mind here in the lithium space, and it's going to be a great time. So my view has not changed. I think the general indexes are going to get crushed. Energy is going to move higher. And I think the recession is going to hit. This is the 1970s on steroids, Phil.
Yeah, so tomorrow, guys, we're going to talk about that, and also why this stock market seemingly defied gravity. We're going to talk about some specific things that were in play basically from when the debt ceiling was raised until now, which has come to an end. Technically ends tomorrow, so we'll talk more about that in detail. I think you guys will find that really interesting, because it's going to be an important turn in the markets if we are correct. So stay tuned for that. And other than that, I think that's going to do it for today's video. Tell us what you guys think about the information presented here. Do you think energy is on a bull run until things start to top out? I personally do. That's actually recessionary. Typically, when we roll over to recession, energy does really well. So we'll see how that plays out. But let us know your thoughts on the other things that we presented here. And we'll see you guys on tomorrow's video. Please hit that like button. Please subscribe. Please set your notifications to all. And check out our stuff over at tradegenius.co. We'll see you guys later.
Trade Genius.